What is a central bank and how does it work? Who really controls the money we use every day? Have you ever heard of central banks and their role in the economy? Some call them the real owners of the world, but what are they really? If you have these questions, stick around because today we'll explain in a clear and simple way what a central bank is, what it's for, and how it works. What is a central bank? A central bank is the bank of banks, a public institution that is responsible for managing the monetary policy of a country or group of countries. Its goal is to maintain economic stability, control inflation, and promote employment. Unlike a commercial bank where we deposit money or ask for loans, central banks do not operate directly with the public. Instead, their work is oriented towards managing the economy from above, setting the rules for banks, and therefore for the entire financial system. What tools does a central bank have? Central banks have various tools to influence the economy. The main ones are controlling interest rates. If rates go up, money is more expensive and access to credit is limited. If rates go down, money is cheaper, which encourages loans and spending. Managing gold and foreign exchange reserves. These reserves back the currency and allow for the management of international trade. Controlling the amount of money in circulation. They decide how much money to print or withdraw from the market to keep the economy balanced. Regulating the minimum reserves of commercial banks. Banks must keep a percentage of deposits as reserves, and the central bank decides how much. Lending money to commercial banks. They act as a lender of last resort to ensure financial stability, supervising and regulating the financial system. They ensure that banks comply with regulations and operate safely. Impact on the economy, interest rates and inflation. Managing interest rates is one of the most powerful tools of central banks. When interest rates go down, money is cheaper for banks, who in turn offer loans to businesses and individuals at lower interest rates. This encourages spending and investment, boosting economic growth. However, if there is too much money in circulation, prices go up, generating inflation. When interest rates go up, money becomes more expensive, which reduces loans and therefore the amount of money in circulation. This helps control inflation, but it can also slow down economic growth. Example: Federal Reserve and European Central Bank. Two of the most important central banks in the world are the Federal Reserve, known as the Fed, is responsible for the US dollar, the most influential currency in the world. The Fed's decisions affect the global economy. The European Central Bank, or ECB, manages the monetary policy of the countries that use the euro. Although the Eurozone countries have their own central banks, most monetary decisions are made by the ECB. Conclusion: central banks are key players in ensuring the economic stability of a country or region. They control the flow of money, regulate inflation, and make decisions that affect our daily lives, from the price of bread to mortgage interest rates. Now that you know how they work, what do you think of their role in the economy? Do you think they have too much power, or that they are essential for global balance? Leave us your comments. And if you liked this video, don't forget to like, subscribe, and activate the bell so you don't miss the next content. See you in the next video.